Guys, what if we told you that right now, becoming a millionaire is much easier than you think? It doesn't matter how much money you have in your current portfolio or how little your capital is. All that matters is what stocks you buy and your holding strategy. Walk with us for a second here. Warren Buffett bought his first stock at the age of 11, long before he became the Oracle of Omaha, right? So doesn't that tell you that you don't need a high level of intelligence?
Quality. You don't need tons of IQ in this business.
If you started investing $250 every month in 1985, you could have made $1.8 million today. And that's a return of over 6,000%. But between us, that's not even close to crazy. Even if you have only $1 and never invest another penny again, you can still be a millionaire in 30 years. The caveat? Well, hitting gold on an amazing S&P stock that returns a minimum of 58.5% annually. Sounds impossible, right? But not necessarily. In 2023, as many as 6 stocks in the S&P 500, including Nvidia, Meta, and Tesla, all gained more than enough to meet that stellar threshold. But in any case, an annual repetition for 3 decades is far from easy. The S&P 500 typically only returns about 10% a year on average over time. But thankfully, there are juicy levers that we can pull to hit that 7-figure mark. And of course, we will be talking about all of them right here in today's video. But make sure you stay until the end, as one of them will teach you how to make $3.5 million from a $250 monthly investment. But before we dive into it, always keep 2 things in mind. One is to keep an emergency fund worth at least 3 months of your living expenses. And secondly, investing is neither magic nor a get-rich-quick scheme. Investments work best in the long term, and anything other than that is likely a Ponzi scheme that you need to avoid like a plague. So, without further ado, let's begin, albeit differently. Instead of diving straight into the technical mumbo-jumbo, let's assume you're a newbie investor with zero idea of how to invest in stocks. Starting off, the first thing you need to do is create or set up an account. Now, a lot of people get stuck at this stage, as there are so many different investment platforms and accounts out there with several perks. But believe it when we tell you, it's a lot simpler than portrayed. Especially now that you can do it all online from the comfort of your bed with your phone in your hand. Guys, the account you should be working on opening here is the one that's actually tax advantaged, which means you won't have to pay any unnecessary taxes. In the United Kingdom, these are known as stocks and shares ISAs and Roth IRAs in America. Some say the UK option is better, as you can invest up to $20,000 a year without paying capital gain tax on your profits. And you can take out your money whenever you want. In contrast, not only will Americans have a significantly lower limit of $6,500 per year, but they also generally cannot withdraw from retirement accounts, like 401ks or individual retirement accounts, before the age 59.5 without paying a penalty of 10%, as well as any taxes they may owe. But of course, while there are exceptions, such as significant medical expenses or navigating the economic repercussions of the COVID-19 pandemic, the general rule of thumb is that once you put your money into a tax-advantaged retirement account, you shouldn't touch it until you've reached retirement age. But hey, it all boils down to your preferences. The clauses on Roth IRAs kind of secure your financial future when you're old and retired. But once your account has been created and you deposit some money to start investing, you'll usually get a wide array of different options, like debit cards, Apple Pay, and bank transfers. Again, just pick the option that you prefer. But next up is where the magic begins. Here, we will be talking about how to formulate a strategy that's almost certain to win every time, including a dangerous mistake that you must avoid at all costs. So make sure that your eyes and ears are peeled, because this is really important. First and foremost, though, if you were asked to name one of the most significant characteristics of stocks, what would your answer be? The fact that they go up and down? Well, good. Like the ocean, stocks can never be stale. They're always moving, and this exact feature makes them so hard to predict. And that's why a lot of winning investors prefer to invest in all of them. Sounds a bit crazy, right? Well, walk with us for a second. Remember when Warren Buffett said that one of the worst mistakes to ensure investors keep losing money is the fact that they're always keen on listening to the winning advice from investors? No? Well, check this out.
Well, the biggest mistake they make is listening to a lot of other people and buying something because they think it's going to go up next week or next month, and for whatever reason people give you.
Don't make the mistake of picking individual stocks that you think will do well just because others are saying so. Instead, keep your eggs in multiple baskets before spreading your wings. Think of it this way. Do you have an account on Twitter, or should we say X? Good, because it's the perfect description of what we'll learn. Okay, so if you have an X account, you should be aware of trend tables. Thus, the menu is where you'll see the words that are trending the most in your country, or even the world, to keep you up to date on breaking news. The more those specific words are used in tweets, the higher they'll go up on the table. But on the other hand, when the word starts to lose heat and people stop using it, it'll drop out of the table, getting replaced by whatever is more recent. This is almost exactly the same as investing in an index fund. All you have to do is switch out the trendy words for companies. Let's take the S&P 500 for example. This list comprises 500 of the largest public companies in the USA, featuring major players like Amazon, Google, Apple, and Tesla. But here is the beauty of the index fund. With just a simple click, you're not merely investing in one or two companies, but every single company on the list. So if one doesn't perform well, your money's still pretty much okay, as the diversification spreads you across the entire spectrum. So, how can we implement this? Remember the saying that out of sight is out of mind? That's exactly why we need to automate our long-term investments. Once you make that initial setting, you can still keep your portfolio active even if you forget it. Plus, it eliminates the need to reduce your monthly investment because you're up to date with those debits. But remember, you're not going to win without accumulating and reinvesting your dividends back into the stocks automatically. The less you have to think about, the better. That said, are you wondering why it's important for you to keep reinvesting? Well, that's easy. It uses the principle of compounding, a cycle where the value of your initial investment will keep growing exponentially over time. Billionaire investor Warren Buffett never shies away from waxing lyrical about the power of compounding, especially when it comes to investments. As a matter of fact, he is often quoted as saying, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." But hey, how about some quick math? In this section, we're going to be showing you how much you can make in some years with different capital and rates of return. Please pay attention to get the full idea. If you are currently 25 years old and you invest $1,750 every month with a 3% yearly return, you'll hit the $1 million mark by the age of 55. And if you instead contribute to investments that give a 6% yearly return, then you would have to invest only $1,050 per month for 30 years to end up with $1 million. But how about an investment that returns a yield of 9% every year? You'll only need to invest about $590 per month to be a millionaire by the age of 55. But how about we spice things up a bit by taking things even further? Let's assume you invested $250 a month for 31 years. Despite having invested $94,000 of your own money, did you know that your portfolio would be worth $1.14 million? If you still hold on to that expanding to 40 years, your portfolio will be worth $3.56 million. As you can see, this value projection is really simple, as it shows you how much money you could make for something so simple. But do you remember what we said about stocks being like the ever-moving ocean? When you invest, you can get back less than you invested, as investments can rise and fall.
Stocks are safe for the long run, and they're very unsafe for tomorrow.
That said, there is one major caveat worth mentioning. Having $1 million in 2054 isn't the same as having it right now. Inflation, which has been running hot for months, eats into the value of money, and it can get quite crazy. In fact, did you know that having $1 million 30 years ago is like having $2.1 million today, thanks to the cumulative inflation of nearly 110% during that time? But here's where things get interesting. While inflation obviously reduces the value of money over time, as long as you are investing, and not just keeping your money safely locked in a bank account, then inflation is not something you need to be extremely worried about, especially if you keep raising your investments to keep up with the pace of inflation. So, now that you are well aware of all the steps you need to make crazy amounts of money in the long term, here lies the million-dollar question. What exactly is holding you back? Remember, compounding ages are like fine wine. It gets better as the years go by. Allow us to demonstrate this. If you began investing in the stock market at the age of 30, did you know that you would only need to contribute $5,000 annually to hit the million-dollar mark by age 65? That's a far cry from waiting until you are 45. Here, you will have to invest up to $20,000 per year to reach that same $1 million by the same age of 65. Soak in the difference for a little bit. Wouldn't you say that's crazy? That is a whole difference of $15,000 just to hit the same benchmark. So tell us why you shouldn't be starting young. Warren Buffett is many things: father, sage, billionaire philanthropist, CEO, icon, and one of the greatest investors of all time. However, he may not have been all of these without stocks. Yes, that's true. Back in 1933, he once said, by periodically investing in an index fund, the know-nothing investor can actually outperform most investment professionals. And this still holds true to this very day. Guys, if you have a diversified portfolio of index funds and keep investing in it at a gradual rate each and every year, you will retire as a millionaire, 100%. And guess what? Just like we said earlier, even if there is a stock market crash, historical data proves that you will be able to weather the storm, just like Warren Buffett did in all those recessions and crashes.